All right, so now that we have discussed the income statement where we talked about revenue recognition first, we then looked at expenses, and finally we discussed items that come below the operating profit, such as non-operating income, unusual or infrequent items, income from discontinued operations, and we also discussed accounting changes as well. So the very last thing right below the net profit or net income that you find is earnings per share. And both IFRS and US GAAP actually require the presentation of EPS on the face of the income statement. So it has to be presented right at the bottom of the income statement. So before we discuss earnings per share in detail, here is what I want you to simply understand. So when we speak about shareholders, there are two types of shareholders. Number one, you have our preferred shareholders. You may call them preferred shareholders, you may call them as preferred equity. And you also have another type of shareholders called ordinary shareholders, or also commonly under US GAAP, they are referred to as common shareholders or common equity. So what's the difference between these two types of shareholders? You may refer to them as investors, owners, etc. So preferred shareholders, the reason why they are actually called preferred is because they have a priority in receiving the dividend. As you may recall, we said before, dividend is a distribution of profits. So when it comes to the profit, which is the net income, who is paid the dividend first? So the preferred shareholders have actually a priority in receiving dividend. They get the dividend first. The second most important thing is that the dividend that they get is fixed. So the dividend could be like 5% of the par value. So just like interest that is paid on the borrowed money is fixed, likewise, the dividend that is paid to the preferred shareholders generally is fixed. So they get a fixed dividend, and that too, they get the dividends first before the common shareholders are actually paid. Another key difference is also that when it comes to liquidation, when a company is liquidated, when the company is closing down and everything is being sold, all the assets are being sold, first the creditors are paid, if you recall. So we know from the assets, first the creditors are paid. Whatever is the leftover amount, first the preferred shareholders would be paid. So from this, preferred shareholders would be paid their due share, and then the leftover will actually belong to the common or ordinary shareholders. So here's what we are saying. They also have a priority at the time of liquidation, meaning after the creditors, the preferred shareholders should be paid, and the leftover, whether if there is anything left or not, would actually go to the common or ordinary shareholders. So they also have a priority at the time of liquidation, priority over the common shareholders, of course, not over the lenders or the creditors. On the other hand, common shareholders, they don't get a fixed dividend, so their dividend is variable. So if the company's performance is very good, it did very well, the company's profitability has been superb, the board might announce a very high amount of dividend, which will be linked mainly to the performance of the company. And at other times, when the performance is bad, the dividend might actually be low. So the dividend is variable, and they are the ones who get the dividend at last. So after all the expenses have been paid, after interest has been paid, after preferred dividend has been paid, then they actually get the dividend. Not only that, at the time of liquidation, they get their stake only after all creditors or liabilities have been paid and preferred shareholders have been paid. And if assets were insufficient to pay them off, then in that case, the common shareholders might simply not get anything. So if I ask you, who do you think appears to be the real owner? Who is taking more risk? Who has the residual risk? So in case if the company does well, you earn well. In case if the company does bad, you don't get much. Or if the company closes down, you may get something after paying off all the other creditors and preferred shareholders. or you may not get anything if there are insufficient assets. So you can clearly notice that ordinary shareholders take on more risk, therefore they are more like the true owners. So when we refer to earnings per share is actually mainly calculated for ordinary shareholders. So I often say that the term itself is deceiving, because you might think that earnings per share is calculated as earnings, which is net income. You may also refer to that as earnings over divided by number of shares, right? That's what comes to mind. You simply divide the earnings by the number of shares, but that's wrong. You don't calculate the EPS as earnings over number of shares. Rather, you calculate the EPS only for the common shareholders, not for the preferred shareholders. So here's what we need to understand, and this is something that I would be rewriting several times. If you understand this well, you should be able to go through this section more smoothly, because oftentimes students try to memorize formulas and it doesn't really work. It doesn't help much if especially the questions are changed a bit. So here's what you need to actually remember well. So in the income statement, what you see is the operating profit, or also commonly called EBIT, which is earnings before subtracting the interest and tax. So far from this profit, interest and taxes have not been subtracted. So from this, we subtract interest expense. The profit before tax, or earnings before tax, is what you will get. You have not yet subtracted the tax expense. When you subtract the tax expense, the profit left after paying off interest and tax is called net income, net profit, or net earnings. And as we said, who gets paid the dividend first from the net income, and who has a fixed dividend? That's preferred shareholders. So from this profit first, preferred shareholders are paid preferred dividend. So PD here refers to the preferred dividend. So once preferred dividends have been paid, the leftover profit that solely belongs to common shareholders or ordinary shareholders is called earnings belonging to common shareholders. You can give it any name, but I would like to give it EBCS, meaning it's a profit that belongs to common shareholders. This is a profit that solely belongs to common shareholders, and they are the ones who can only lay a claim on this. Out of this profit, a certain amount would be paid as common dividend, and the rest of it would actually be reinvested. So I repeat again, from net income, we subtract preferred dividend. And once that is subtracted, the leftover profit is called profit belonging to common shareholders, or earnings belonging to common shareholders. So when we speak about earnings per share, we have something called basic earnings per share. And we'll talk about why is this called basic in a while. It's calculated as I said, earnings per share is mainly for common shareholders. So you're not going to take the net income and divide it by the number of shares. Rather, you are going to take the earnings belonging to common shareholders, which is EBCS. This gives you the profit that belongs to common shareholders, and you divide this by the number of common or ordinary shares. You don't divide it by the total shares, which is preferred plus common. You only divide this by the number of common shares. Alternatively, we can rewrite this as EBCS, as we have seen here, can be calculated as net income minus PD. After subtracting the preferred dividend, the leftover profit is earnings belonging to common shareholders divided by number of common or ordinary shares. Now the question that comes is, should we use the beginning number of common shares? Because one thing you need to understand here, the number of common shares can change. A company might have 1 million shares at the start of the year, and then it issued more, and it also bought some shares back. Therefore, the number of shares would actually change throughout the year. The beginning number of common shares would be different than the ending number of common shares. And here is a question that I want you to try and think of. Should we use in the denominator beginning number of common shares, which is the number of common shares at the beginning of the year, or ending common shares, or average common shares? Now, the answer to this is we will actually use weighted average common shares, weighted average number of common shares. Why is that so? Well, if you pay attention to the numerator, the earnings belonging to common shareholders or earnings are earned throughout the year. So the earnings are not earned at the start of the year nor at the end of the year. Rather, these are earned throughout the year because you sell goods throughout the year. So you earn revenue throughout the year. You incur expenses throughout the year. Hence, the profit is earned throughout the year. Hence, it would make sense to use weighted average number of common shares. So we would use weighted average common shares, and same goes here. We use weighted average common shares. In short, let's call it WACS, weighted average common shares. That is what we will actually use in the denominator. So we will look at some examples to try and see how we actually get the weighted average common shares. All right, let's jump to the example now. So here's the example that we actually have. For the year ended 31st December 2018, Angler Products had net income of 2.5 million. The company declared and paid 200,000 of dividends on preferred stock. The company also had the following common stock share information. So the shares outstanding on 1st January 2018 were 1 million. Shares issued on 1st of April 2018 were 200,000, and the shares repurchased on 1st of October 2018 were 100,000. So when you issue shares, that increases the number of shares. When you buy back shares, that decreases the number of shares, and this should then give you the ending number of common shares or ordinary shares, which are 1.1 million. So we have two questions here. Number one, what is the company's weighted average number of shares, which is weighted average common shares? And the next question is, what is the company's basic EPS? So let's try and find the denominator of EPS equation first, which is weighted average common shares. With all this data given to us, let me show you a pro forma. If you stick to that, hopefully this would be easy for you to actually find the weighted average common shares. One thing, we're going to weigh the common shares by time. So you're going to count for how many months were the 1 million shares outstanding, for how many months were the 200,000 shares outstanding, and so on. So let's look at the pro forma on the next slide. So let's look at this example, first part. So here's what you'll do. You would say, the first thing we are going to have in our pro forma is we'll put the date. All right, and I'm going to show you how to count the months or how to write the date properly. Then we will look at shares, the number of shares. Then we would look at, I like to call this adjusted shares. And I'll be explaining what do I mean by this. Next, we would talk about time. We use time as a weight. And finally, we look at weighted shares. So let's say this is A, and this is B, and this is actually C. All right, so here's how we are going to count the date or the time. If you notice the first transaction, which were shares outstanding on the first or the beginning of the year, were 1 million shares, 1 million number of shares. So since these were outstanding on 1st January, what we are going to do is we're going to count that from the date until the end of the year. And the end of the year is 31st December 2018. So we are going to count, we had 1 million shares that were outstanding from the beginning of January until December. So if you notice, that's entire 12 months out of 12 months. So we can say time, they were outstanding 12 divided by 12, which is 100%. They were outstanding for the entire year. All right, so before I get further, when would you use this column that you see right here, which says adjusted shares? So we only use adjusted shares, number one, if we have something called stock dividends. So normally dividends are always paid in cash. Dividends are profit distributions, which always happens in cash. However, if you get dividend in the form of new shares, so you're awarded new shares, then that is called stock dividends. Likewise, if stock splits happen, and we'll not get into the reasons for why stock dividends are paid, why stock splits are actually, why are stock splits done. But let's suppose if you own one share and each of the share that all investors own, the company has actually split them into two, what we call 2-for-1 split. That means if you own one share, now you actually own two shares. Important thing to understand here is when stock split happens, let's say if it's 2-for-1, that does not mean that the investor wealth has doubled or the company's market value has doubled, because what happens is even though you got more shares, the price of the share will go down. So the net worth of the company and the investor will remain the same. So whenever in the example we have stock dividends and stock splits, we will use this column. Otherwise, we'll keep this as blank. And as you can see in this example, you'll not find stock dividends or stock splits, hence we're not going to use this. So for weighted shares, all we're going to do is we're going to say the shares we have, which is A, times we will weight by the time, which is actually by C. So you weigh the number of shares by time, so that's 1 million times 12 by 12, and you get 1 million weighted shares that have been weighted by time. All right, let's go back. The next transaction is shares were issued on 1st of April. So it's important date. Shares were issued on 1st of April. That increased the number of shares. So let's go down. How many shares were issued? 200,000 shares were issued on 1st of April. So we are going to include April as well. We're going to count from April until end of the year. So that means these 200,000 shares were outstanding for a total of, if you count these months, that's 9 months out of 12 months. So we are going to say 9 out of 12. These 200,000 shares were outstanding for 9 months out of 12. If you weigh 200,000 by multiplying it by 9 by 12, as you see here, you will get plus 150,000 shares. In other words, the 200,000 shares are equivalent to 150,000 shares. So 200,000 were outstanding for 9 months, but we assume as if they're equivalent to 150,000 that have been outstanding for the entire year. Okay, let's move to the next transaction. Shares were repurchased, so shares were bought back, 100,000 shares on 1st of October. So if we count from October to December, we have 3 months. How many shares were bought back? 100,000, so that's negative sign. Again, that's 3 months out of 12. If we multiply 100,000 with the 3 by 12, we would actually get minus 25,000. And if we net this out, what we would actually get is called weighted average common shares, or weighted average number of shares. In short, I like to call it WACS. So if we net it out, it's 1,125,000 shares. So we have got the weighted average common shares. Let's look at the second part of this particular example. What is the company's basic earnings per share? So if we look at the basic EPS formula, we said basic EPS is calculated as net income minus preferred dividend divided by weighted average common shares. If they don't give you net income, if they give you EBCS, you don't have to subtract the preferred dividend, as we said before, because net income minus preferred dividend gives you earnings belonging to common shareholders. So keep that in mind. Make sure and read carefully as to what you have been given. If you notice, you're not given EBCS, you're given net income. You're also given 200,000 preferred dividend. So all we're going to say is net income of 2.5 million minus 200,000, which is preferred dividend, divided by 1,125,000, and this should give us the answer of 2.04. That's your earnings per share, or basic earnings per share. All right, so let's look at the next example. Assume the same facts as in previous example, except that on 1st December 2018, a previously declared 2-for-1 stock split took effect. each shareholder receives 2 shares in exchange for each current share that he or she owns. So for each 1 share, you get 2 shares. What is the company's basic EPS? As you can see, because stock split is happening, the denominator will double. Therefore, you would expect that the earnings per share will certainly drop down after the split. And let's prove that. So we have the same data in this example for the next example, but one thing has been added, that 2-for-1 split happened here on 1st of December, 2-for-1 split. Although it would have been good and much more intuitive if the split had happened before the repurchase. Anyways, let's look at this example, and then we will also talk about what if it had happened before the October, how would you actually deal with this? So if we do that, I would like to look at weighted average common shares. Again, let's talk about the weighted average common shares, and let's rewrite the pro forma for weighted average common shares. As we said, first you have date, then you have shares, and we have adjusted shares. So we are going to use this column now. Let's say this is A, so this would actually be B. Then we use time as weight, and say this is C, and then we have weighted shares. All right, so since we are actually having stock split, therefore we are going to use this. But before that, let's go step by step through the transactions. So shares outstanding on 1st January, 1 million shares are outstanding. So what we are going to say is we have 1 million shares on January. So we count from January to December. That's 12 by 12. Let's leave the rest of it right now. Let's move next. We have on 1st of April, 200,000 shares were issued. So from April to December, 200,000 shares were issued. Again, for 9 out of 12. Let's move next. On 1st of October, there was a repurchase. So from October to December, there was a repurchase of 100,000, and that amounts to 3 months. They were outstanding for 3 out of 12 months. That will be the impact. And then we are told that on 1st of December, 2-for-1 split happens. So whenever a split happens, you will not going to give it a separate row. So if there is a stock split or a stock dividend, you're not going to write that as a separate row. Rather, split and stock dividends always affect the number of shares that are outstanding until that date or on that date. So the number of shares or the number of transactions that you see here are these 3. So we are going to make adjustment to these 3 transactions because the split happened in December. So anything that has come before the split would, any shares or any share related transactions that has happened before split would be affected. But any transaction that happens after the split would not be affected by the split. So let me show to you how would be the adjustment we would actually make. If there were 1 million shares outstanding and there is a 2-for-1 split, that means each of it would double. So it will become 2 million shares. Again, 200,000 would double, and this will become plus 400,000 shares. Again, repurchase stocks, this would double, and the impact would be, it's equivalent to 200,000 shares after accounting for the repurchases. And here's what we will do now. We will say weighted shares are calculated as B times C, as opposed to A times C, what we did earlier. So you'll say 2 million by 12 by 12. You multiply this, 2 million times 12 by 12. That's 2 million shares. Plus 400,000 times 9 by 12 is 300,000 shares. And finally, 200,000 times 3 by 12, that's around 50,000 shares. So you'll subtract this just to make sure it's not double minus. Anyways, you will subtract this and you should get 2.25000. So 2.25 weighted average common shares. So that's how you will get the weighted average common shares. Just one thing to add. Had the split happened, let's suppose if we go back and say, what if the split had happened on 1st of September, somewhere here? Then you would just go and make the adjustment only to these shares, not to the repurchase shares, because this transaction is happening in the future, not prior to the date of when the stock split or stock dividend actually happened. Another important thing, if we were told instead of stock split, if it was a 10% stock dividend, what would we do in that case? We would just increase the 1 million shares by 10%, meaning in short, you could say 1 million times 1.1 will give you 1.1 million shares. 200,000 times 1.1 will give you 220,000 shares, and 100,000 times 1.1 will give you 110,000 shares. So that's how you would actually do in case if you were told about stock dividends. The adjustment would be the same. All the transactions that happen before the stock dividend date should be adjusted, but the transactions that happen after the stock dividend date should not be adjusted. So let's get our basic EPS. Since we are given net income, we say net income minus PD divided by weighted average common shares. Net income is 2.5 million. Preferred dividend is 200,000. And we are told that we have calculated the weighted average common shares as 2.25 million. Let's see what answer we get. It is 1.02. So as expected, as you can see, before the earnings per share was 2.04, and now it has actually dropped down to $1.02. All right, now that we have understood how to get the basic earnings per share and how to calculate the weighted average common shares for basic earnings per share, let's talk about another term, which is capital structure. So capital structure refers to, capital structure refers to the different sources of capital that you could actually get. If you recall previously, we said that assets can be funded by debt and equity, which is liabilities plus equity. So you could either borrow money to fund your assets, or you could either raise money from the owners to fund your assets. So broadly speaking, capital here refers to any source of fund, which could be debt, which relates to borrowing, and you can borrow either through bank loans or by issuing a bond, or it also refers to any money raised from the owners, which is owners equity, which could be common equity or which could be preferred equity. So if I refer to the capital structure actually refers to the proportion of different sources of capital in your overall total capital. So how much is the proportion of debt and how much is the proportion of equity in your total capital? That is what is capital structure. So in your capital structure, you can have debt, which includes bank loans. You can have, you can issue bonds, simple bonds. You can have preferred shares. So these both are debt, and preferred shares is equity. You can have common shares or ordinary shares. So these are different sources of funds in your capital. So your capital is made up of debt, which is bank loans and bonds, and it's made up of equity, which is preferred shares and common shares. You can also have some securities in your capital, which are called complex securities, such as you have convertible preferred shares. You have convertible bonds, and you also have convertible, stock options, or you may also say warrants. And we'll talk about each of these one by one. We'll be discussing this extensively in detail. So when you have a capital structure that only includes these securities, then it's called simple capital structure. So let's say in short, CS represents capital structure. So then you have a simple capital structure. However, if you add any one of this security to a simple capital structure, then they make the capital structure complex. So if you have, for example, bank loans, bonds, preferred shares, and common shares, but you've also issued convertible bond, then that means the capital structure would actually be complex capital structure. So the addition of any of these three items to a simple capital structure would simply make your capital structure complex. And the reason being is this: these securities are referred to as potentially dilutive securities. All right, although we'll be talking about each of these one by one, but what's a convertible preferred share? Just to quickly discuss this, it's a preferred share in which the holder of the preferred share has the right to convert it into common shares. In short, what we are saying is the investor who owns a preferred share has the right to convert it into common shares. Likewise, convertible bond, it's a bond in which the holder has a right to convert it into common shares. So the reason why these are called potentially dilutive securities is because if they are converted, or if the form of these securities change, that might bring the EPS down. So let's suppose the company has issued some convertible bonds, and what if today those bonds are converted into common shares? If the conversion would bring the earnings per share, the basic earnings per share down, then this is referred to as dilutive security. So they might be dilutive, they might not be dilutive. That's why we call them potentially dilutive securities, meaning they may bring the EPS down if their nature or form changes, or they may be anti-dilutive, meaning they might increase the EPS. And here's the key idea. As accountants, they have to find whether these securities are dilutive or not. And if they find them to be dilutive, then they would not only report basic EPS in the income statement, but they would also have to report the dilutive EPS on the face of the income statement. So our next exercise is going to be one by one how to check whether these securities are dilutive or not, meaning do they bring the basic EPS down or not.